Good afternoon and welcome to the MERCIA Asset Management PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Mark Payton, CEO. Good afternoon, sir.
And thank you. And welcome everybody to MERCIA's preliminary results for the 12-month period to the 31st of March 2024. I'm Mark Payton, co-founder and chief executive of MERCIA, strong background in life sciences and still have life science responsibility on certain portfolio companies. I'm joined today with Martin Glanfield, MERCIA's CFO.
Yes, good afternoon, everyone. I joined MERCIA almost 10 years ago now to float MERCIA with Mark when there was just a small handful of us. My background is mainly as a CFO of listed and private equity-backed technology-led businesses in the UK and the US.
Thank you, Martin. Also within the executive team is Julian Biggers, MERCIA's Chief Investment Officer, and recently joining us, actually from a successful Oxygen sale a while ago, which is a portfolio company. Joe Bath joins us as Chief Operating Officer. So this slide really demonstrates, and what we've been referring to, the natural evolution of the business, is the growth from predominantly the third-party funds under management, and highlights some really key features of progress made in this 12-month period. Revenue has grown by circa 17.6%. That's up to 30.4 million compared to this time last year. And alongside that, EBITDA at 5.5 million is a 6.7% increase, again on a year-on-year comparison. The proposed final dividend for this period is 0.55 pence per share, up by nearly 4%. And actually, with the cash generative nature of the fund management operation and the successful Endream sale towards the end of the calendar year last year, we have cash on hand at 46.9 million. And again, that is up from 37.8 million this period last year, and the group is debt-free. Assets under management have grown by over 26% to 1.8 billion, and of that 1.6 billion is through managed funds. And that growth has come predominantly through organic growth in terms of funds inflows, nearly 600 million in this period. So a strong period of growth for MERCIA. And this period sees the end of what we termed the MERCIA 2020, where this had three key metrics over a 3-year period. AUM growth by 20% per annum over those 3 years. PBIT, profit before tax, by 20 million per annum over 3 years. And then the start of what we call the progressive dividend policy. Looking at AUM, I'm pleased to say that we are at 1.8 billion. So we beat our target of 1.6 billion for that 3-year period. Profit before tax, we've arrived at 21.6 million, so fallen short of the original 60 million target, which was predominantly driven by fair value movements, etc., from our balance sheet investment activity. But due to the profitable cash generative nature of the business, the progressive dividend has continued from the initial 0.8 pence per share. And in terms of the direct investment portfolio over a circa 7-year period, you can see the 9 exits that have been realised from the balance sheet. If you add those up against investment cost and realisations, we've invested approximately 35 million in those 9 assets and realised 104 million in value, of which over 100 million is in cash straight back to the balance sheet. That's a 3 times return on invested capital. So the balance sheet has performed well over that period, and importantly has been generating cash back to the business to grow and keep that sustainable growth for the business going forwards.
Thank you, Mark. This slide shows our substantial growth in assets under management, revenues and EBITDA during the last 4 years. And over the 4-year period, AUM has grown 94% from 940 million to 1.8 billion. Revenue has grown from 19.2 million to 30.4 million, and EBITDA has grown from 3.3 million to 5.5 million. It's obviously during a period when we've had both COVID and the prolonged period of significant cost inflation. As you can see on this slide, MERCIA's AUM grew by 27% to 1.8 billion, and all of this growth this year was organic. There were no redemptions, and the only reduction of any magnitude was the original 3-year British Business Bank 10-year funds and our small PE fund ending their respective 5-year investment phases. When this occurs, our revenues become based on the net asset value of each mandate rather than as a percentage of the original mandate size. And once again, it's been a very strong year of AUM growth, despite the continuing challenges across the wider asset management sector. This slide provides more granularity on the makeup of our AUM by asset class, investor type, and fund type. Combined, these typically long-dated or evergreen funds are generating a blended fee margin of circa 2%. And this is across what we have now is 61 different investment mandates. And we are increasingly able to equity invest or lend across the UK under the many different fund mandates that we manage. As you can also see, we are diversified by investor type and asset class, and 76% of our revenue is contracted and recurring, which is a great comfort to us during these unpredictable times, with the remaining 24% arising as a direct result of our investment deployment. This is our income statement in accordance with international financial reporting standards. So you see the revenue increase of 17.6%, but what you don't see here in this format is the EBITDA of 5.5 million, nor do you see the 9.7 million, which is what we call the adjusted operating profit, which is EBITDA plus net finance income. Our balance sheet remains extremely strong with 190 million of net assets. During the year, we invested just over 19 million into the balance sheet portfolio. And we still have, at the end of the year, significant liquidity with 47 million pounds and no debt. And that is why we're able to propose to shareholders a final dividend of 0.55 pence, a 4% increase on the prior year. MERCIA is about generating cash from its operating activities and not reliant purely on realizations for cash inflows. And as you can see here, during the year, our operating activities, our fund management activities generated 7 million of cash inflow. And our investing activities, thanks to the significant disposal of our investment in nDreams, we generated more cash from our investing activities than from investing into the balance sheet portfolio, with a net effect of 9.4 million of cash inflow. In terms of cash outflows in the year, we paid 1.5 million in deferred consideration to the vendors of FDC, the business we bought just over 12 months ago. And we also, in the period, spent 3.2 million of the 5 million allocated for the share buyback, which ended in May.
Thank you, Martin. Over the next section, I'll talk about investment performance of the group, initially through our fund management operation, and then latterly into the direct investments. Just to remind those about MERCIA and how we operate, we manage broadly what we call strategic assets within MERCIA Ventures, MERCIA Debt, and MERCIA Private Equity. If you look in MERCIA Ventures, we can invest anything from as little as 0.5 million up to 10 million on a regional and on a national basis. We exclusively deploy capital within the UK. We deliver that through one of our 11 offices across the country, from London all the way to Newcastle. We have 913 million in funds under management within the Ventures operation, and importantly, 404 million of which is in unrestricted free cash to invest going forwards. MERCIA Debt can invest anything from 0.2 million up to 20 million, again on a regional and national basis. 687 million of funds under management within our debt teams, 262 million of which is unrestricted and free cash. MERCIA Private Equity, which is a relatively small fund, and as Martin says, gets adjusted into its harvest period on a net asset basis. That's shrunk because it's returned capital back to the limited partners in that fund. That fund is performing very well, and we're in the process of a follow-on fund to come after that. And that typically invests anything from 2 million to 10 million. And then our proprietary capital I'll come on to in a moment. But if you run through that right bar, the 713 million of unrestricted cash across the group in a 1.8 billion asset under management business, we have substantial capital in picking new deals and supporting existing portfolio. And then on to our proprietary capital, our direct investment portfolio. On this table is listed the 20 assets we now hold on the direct investment portfolio, with the Endream sale moving across towards the bottom. So we started the year at 136.5 million. We invested 19.6 million across the portfolio. If you remember, for those that have been following us, we stopped making new investments this time last year. So this is just existing portfolio being supported. With the successful sale of Endreams, approximately 26-27 million came back to the balance sheet, and a modest stake, circa 3.7 million, remains within the acquirer, Aonic, and I'll talk to that in a moment. The fair value movements of that transaction is shown there, the 4.5 million. Then with fair value movements upwards and downwards, we have a net provision position of 17.3 million, predominantly driven by the full provision of Impression Technologies. In our interims, we reported on a 50% provision against Impression Technologies following an unsuccessful sale of the business. We restarted that. That did not result in a successful sale, and hence the full provision against that asset. So we closed the year with that provision and the full sale of Endreams at 116.8 million. Now, of those 20 holdings, the top 10 account for about 60% by value of the direct investment portfolio. And here listed is the top 5 of those top 10. We have Vox PopMe as our number 1 holding by value, strong revenue growth, strong ARR growth. Business is now at a break-even position, so it does not require any more support on a capital basis from us, and that business continues to progress well. MERCIA, which is a bot detection and mitigation platform in a real-time basis server side. Again, strong revenue and ARR growth. We have a final plan to get that business to break even and are looking to support that to that case. Warwick Acoustics, a business developing electrostatic flat speakers, both in very high-end, high-quality headphones, as well as now integrated into the automotive sector, again, continues to perform extremely well. We had a recent funding round into that business with an external investor. MedHeron, this is a business in the life science medtech space. It has a significant partnership with Bayer and is developing an in-house HRT testosterone patch, which has gone through clinical range finding dosing and is now moving into a registration trial in due course. And then finally, in the top 5, we have Avid Games with their game, The Cards, the Universe and Everything. That's a business actually where revenue has plateaued, and because of the softer revenue multiples in the gaming sector, we've actually taken a provision against that business and lowered its value of holding. Then into the next 5 businesses, we have Invincible Studios, which is Soccer Manager. We've seen revenue continue to grow in that business, but to my point before, due to the softer revenue multiples in the gaming sector, that's taken a modest provision against that holding. Locate Bio, which had a recent and successful fully funded round, is about to enter into the clinic on a BMP scaffold to get bone repair. That business progresses well. That round had a slight up round, and hence the write-up in that business. IOTO, in our first half results, because it had slipped behind business plan, we had put a provision against that, and we maintained that provision in the full year. Intelligent Positioning has now got to a break-even position, doesn't require further capital from us, and that business benefited from a modest upswing in valuation. And finally, Aonic, which is our residual holding from Endreams that was sold to them. This is a business turning over approximately 100 million euros, making 25 million euros profit EBITDA, and we have a small stake in that business, and we expect to realize that in due course.
Thanks, Mark. In terms of valuation methodology of private assets, we, like everybody else in the asset management industry, follow what's known as the IPEV guidelines. And in respect of our balance sheet portfolio, 68% of the portfolio was valued based on the price of a last investment round, and 25% of the portfolio was based on an enterprise value basis. We're required to calibrate those principal valuation methodologies, which we always do, and in some cases we'll use DCF as a secondary calibration mechanism, but we never use DCF as our primary valuation methodology. As you can see in the top circle of this page, we only have one direct investment on the public markets, which is My Health Check on AIM. So we have minimal exposure to the volatile public markets. And when we've been through this exercise, which we do every 6 months, we still adopt a final hands-on-heart review, Mark and I and Julian, making sure that we feel comfortable with those final fair values. And in the bottom right-hand corner of this chart, you can see that our direct investment portfolio is still quite well spread against those 4 investment sectors that we've always focused on.
Thank you, Martin. So why hold shares in MERCIA? Why invest in MERCIA? And I guess it's that classic overnight success that's taken us 10 years to build on AIM, where we have now a very sustainable, liquid and profitable cash generative business going forwards. And in terms of the sustainability, this slide brings this somewhat to life. In terms of our third-party funds, as I've said already, 1.6 billion under management, which has grown year on year by 32%. That has dry powder, so unrestricted cash across it of circa 700 million. It in itself has grown 89% year on year. But importantly, if we were to assume, and this will not happen, but if we were to assume we did not raise any new funds for the next 3 years, and we maintain the existing investment rate across our funds in terms of backing new deals and in terms of supporting existing portfolio, we have a 3-year runway of capital here. So a substantial runway for our managed funds going forwards across the asset classes we manage. And then we flow down to the balance sheet portfolio, which you'll see finished on just under 117 million closing at the year end. We have 47 million at the year end of dry powder of unrestricted cash to invest, and we have modelled the portfolio requirement over the next 3 years. And it is important to note, as I'm sure many of you will have picked up about our sentiment here about this being a natural evolution for the group, is that we will be now divesting from our direct investments in an orderly fashion over these 3 years. And we would expect to sell out of most of these businesses within the next 3 years for most of them. And that actually means that it will be generating cash, but in the context of just ignoring that and generating cash, they will be consuming 25 million. So in other words, we have well in excess capital to support the portfolio over the next 3 years as well. So what we have across the group is substantial unrestricted cash, which means for the next 3 years, we can support those businesses going forwards. And then in terms of the group net asset value, if you look at the bar chart below it, of that 189 million, you can see a substantial amount of that makes up what we call the hard NAV, so cash plus the direct investments, a majority of the value of the group NAV. And our investors and our behaviour is very much one of being an impactful and responsible investor, be it through retail, be it through institutional or British Business Bank. And we operate very clearly against those 3 metrics that measure that. If it's within the house, as we look at the electric vehicle rollout, etc., or within our portfolio, we have over 500 companies across debt, private equity and venture, or indeed businesses we back. And Nova Pangea, which is on the balance sheet and it held across our funds, a business focused on bio, aviation, fuel, biochar, etc., a business that's generating a lot of attention and interest. Social impact, we'll have invested over this 12 months from our funds, £227 million, and 90% of that outside of London. We have a London office, and London is an important area for us to invest in, but a majority of our investment expertise and activity is outside of London. And we've backed 155 companies during the 12-month period and leveraged in, alongside that investment activity, 161 million of co-investment. And in addition to this, and I'll talk a little bit about real assets in a moment, we have financed 14 projects focused on urban regeneration in opportunities such as Cornerstone, the Hippodrome here in Birmingham, and Telegraph Building. As a listed business and a business within the financial services, and governance is clearly a very important metric to us. You can see a number of memberships and agencies that we're a member of in that respect. But I also think it's important that the executives, they are measured, and part of the remuneration is against culture and ESG. And importantly, a focus for us over this MERCIA 2020 period is to try and get more women into the financial services industry, which is ostensibly a male-dominated industry. And I'm very pleased to say that 40% of the non-exec directors of this listed business are women, 39% of the executive committee, 25% of the executive team, and importantly, 41% of the entire MERCIA group are women. So work still to be done, but I think a real proactive achievement there. And then finally, with forums such as IMC, which frankly is an excellent forum to reach out to all of you and for you to reach out to us with your questions, we are actively engaged in retail and in institutional events to ensure that we hear and speak to you directly about the changing approach to the business and understand any comments or concerns that you may well have. Differentiated investment strategies and asset classes are at the heart of what MERCIA does. And I've spoken to the strategic asset classes of private venture, debt, and private equity, and of course the balance sheet. But since our acquisition, as Martin alluded to, over 12 months ago now, Frontier Development Capital, FDC, we've moved increasingly into what we call intermediary real asset finance, be that brownfield remediation, regeneration, or social housing or infrastructure. And this is an area of growth from the Midlands that we see going nationally, and real assets will become an important part that will be very complementary to the strategic asset classes that we manage. You can see the split of AUM across at the top table, and at the lower end of the table, the split of unrestricted cash available across all those asset classes.
As you will have seen in this morning's announcement, when we floated on AIM in 2014, we floated as what's called an investing company. And that is because our primary objective in raising the £70 million that we raised back then was to build a balance sheet portfolio, and therefore we were classified as an investing company. And you can see there that post-IPO, the net assets were 81 million and the funds under management were only 23 million. If you roll the clock to today, you can see how our funds under management now dominate our balance sheet net assets. And therefore, over time, we've really become much more of a trading company than an investing company. And to move to trading company status, we need to seek shareholder approval for that move under the AIM rules. And therefore, a resolution will be proposed at the September AGM to do just that.
Thank you.
As you will have seen before, if you've watched this webinar before, we have, for an AIM company, a fantastic blue chip shareholder base that any main market listed company would be really proud to have. And I'm pleased to say that we've had a very stable shareholder base throughout the year, as you can see here on this slide.
Thank you, Martin. So just in conclusion, we have always had, and many of you will be familiar with this, a single vision within MERCIA, which is to be the first choice for investors, investees, and our team, our employees. And these results, which are our strongest as yet, particularly around the fund management operation, demonstrate the delivery against this vision, with a record year of organic fund inflows of 562 million. Liquidity, strong liquidity, which is critical in this environment, of 46.9 million on the balance sheet, but over 600 million in our funds. And I think that sort of 666 in the funds is really important, because what we're seeing at the moment in the current environment of decreasing liquidity is increasing quality and quantity of deal originations across all of what we do. So that is helping us pick bigger and better opportunities as we face forwards. The business performance means we can continue to deliver against this progressive dividend policy, with a proposed final dividend up circa 4%. We benefit from a blended 2% fee margin. And I think the outlook for what we are terming MERCIA 27, so our next 3-year strategic plan, which is 100% growth in EBITDA over those 3 years and to take AUM up to 3 billion, is very positive. We are targeting for this financial year 10% organic inflows of new funds under management. We're building systems to help scalable, efficient approaches as we build our AUM under management. Real assets and associated adjacent asset classes have been mapped out, and we will look to grow in that area. To put that into context, we are currently looking for a head of institutional distribution to join us. We have retail distribution as an internal engine. We're wanting to replicate that now for institutional distribution. We have full and strong alignment across the group with employees, with the management team and the board, with the rest of our shareholders, as we own 17% collectively. And we're in a very strong financial position. We're very well set up to go forwards in terms of our unrestricted cash across the group. And I think importantly, tailwinds for a change, because we've had years, frankly, of headwinds. Any leadership team, I'm sure, would say that. but we see now tailwinds facing forwards as the group's prospects continue to improve. Thank you very much for your attention.
Mark, Martin, thank you very much for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation. Can I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
Forgive me while I just note down these. We're very keen to answer all the questions, but I'll try to theme them. But what I'm going to do... Okay, so I think the first theme is really around the balance sheet investments in their first place. There's a theme about the change of status from investment company, Martin, to trading, which we'll cover off as well. And then there's a theme around about sustainable funds inflow for the business as it grows. So I think on the direct investments, there's an important point here, which is what about those existing direct investments? Well, what we're not proposing at all here is to abandon those direct investments. We strongly and firmly believe in those 20 businesses, and we believe that within the next 3 years, a majority of those businesses will naturally evolve through to an exit. We will continue to support those businesses and have mapped out their capital needs. This is that 25 million approach over the 3 years. A number of those businesses now trade on a break-even basis and are profitable and don't require further support. But we will be supporting those businesses through to an exit. What we are not doing is adding any new businesses to that. This is now about our focus and intention on our third-party funds under management. I think another theme, Martin, is to do with the change of status from investment company to trading company.
Yes, and I'm happy to go into a little bit more detail on that. So, and forgive me if this gets too boring, but for every company that floats on the stock market, you have to, when you're raising money, you have to explain to your potential shareholders what you're going to do with that money. And AIM classifies companies into these two categories. Either you're an investment company, which tends to suggest a passive type company, maybe in real estate management or quoted asset management, or a trading company, typically, let's say a retail company or a manufacturing business or something like that. And I guess we sort of fell in between, really, because we were going to be proactive in investing, but nevertheless, we were going to take in balance sheet money and put that into assets. So we were categorized as an investing company. What that does mean is that when you invest into balance sheet companies from your cash, as an investing company, you do not have to run that transaction through what's called the class tests. Whereas if you were a trading company, you would have to run each balance sheet investment transaction through the class tests. So over the last 9 years or so, every time we've made a balance sheet investment, we haven't had to run the class tests, and we've just been able to make our investments based on the criteria which is set by our board. So moving to a trading company status, if approved by our shareholders, the only sort of slight additional administrative burden will be that we will need to run a class test on every £250,000 or £500,000 investment that we make into the existing portfolio, which is no burden whatsoever. As you may also know, although I'd like to emphasize at this point, we are not giving any tax advice whatsoever, but as many of you may also know, that trading companies on AIM, typically their shares are IHT relief. They attract IHT relief in the event of a shareholder passing away and their estate moving on to their descendants. And so it may well be in the future, depending upon incoming government and future budgets, that if that IHT relief is maintained, MERCIA shares may well, as a trading company, may well then attract IHT relief. As it happens, some years ago, we did receive tax advice that, in fact, MERCIA, as a trading company, albeit categorized as an investing company, its shares may well already attract IHT relief, but HMRC won't opine on that matter until a MERCIA shareholder dies. And what Mark and I have never wished to do is try and make contact with the estate of any deceased shareholder. So we've never, to our knowledge, been able to test that, but we do believe that this transition, should IHT relief still apply to AIM companies, in due course will apply to MERCIA's shares. So I hope that provides a fuller explanation of the rationale.
Thank you. An additional question while I've got you in that case. is there's been a question about the long-term outlook for the dividend growth and capital return to shareholders.
Yes, and we describe it as progressive because, again, some of you will have heard me say in the past, we don't want to be anchored to any particular performance metric, be it a sort of a dividend cover based around profits or EBITDA or operating profit and so on, because of the nature of our business, which does, as you've seen in this year's numbers, fluctuate. Some years we'll have a really good realized gain, a really good cash inflow, and other years we may not. So we would rather, as we've described it, as a progressive dividend, seek to increase the dividend at a reasonable rate year on year, and it is our intention to continue to do that. In terms of other mechanisms for returns to shareholders, you'll have seen that we did undertake a £5 million share buyback over the last few months. And whilst we've no current intention of undertaking another one, it's not something that we would ever rule out again in the future, because striking that balance between using our cash proceeds from realized gains and trading cash flow, striking that balance between using it to accelerate the growth of the business through, say, M&A versus returns to shareholders is a balance that we keep under review.
Fabulous, thank you. And the next few questions I'll take, and these are in no order because they're discrete questions. One of them was the house perspective on life science and life science investments. I think that's a critical question actually in the current environment where we've always tried to shy away from capital intensive businesses, because when such an environment as we are in today, what materializes is syndication risk. In other words, other investors' appetite to do new deals as follow-on investments, and if they don't do them, you're left actually with the burden of that capital intensive business. So our life science businesses within our portfolio actually have quite modest capital needs, the locate buyers, the med herits, etc. We've seen. We are definitely seeing a decrease in appetite for the more deeper capital intensive businesses. And I think until public markets open up for those sorts of businesses, that will continue to be a challenge. So that doesn't impact us. It just reinforces, I'm afraid, our philosophy about not getting into these capital intensive businesses in the first point. The other question was about realized proceeds from the balance sheet direct investments. What will we do with that? Will they go out through dividends? Will they go out through buybacks, etc.? We have, coincidentally, almost every 3 years acquired a business and then looked for organic growth from that business. And to put that into context, our first one that we acquired, which was Enterprise Ventures, we got the first generation of regional funds that came after that acquisition. And the recent good news is the second generation of regional funds that come after that acquisition. So we will be looking at acquisition opportunities. There's not one under consideration at the moment, but we will be looking for that. And in the near term, we believe we can finance that with our own capital reserves. And so very much on the theme of sustainable business in that respect. There was a question on regional focus and whether we would reinforce that and deliver capital to regional SMEs, etc. Very much in our DNA, that. We break the UK down into sectors and into regions. As I said, we do deals in London, we do deals in Cambridge, we do deals in Oxford, but actually a lion's share of what we do, so 85% of what we do is outside of that triangle of Oxford, Cambridge and London. And we have 11 offices across the UK regions. And what that means is that we have the capacity and capability as we scale strategic assets in particular, but also real assets coming through. We have the feet on the ground to do that already. So that will give us and provide us over the 3-year period a degree of operational leverage. Another question which was asked, Martin, was the MERCIA 2027. So we've set out a 3 billion target in terms of FUM, and we've set out 100% EBITDA focus in that regard. And what are the key metrics that what shareholders or what others should be looking to follow as that journey unwinds?
Yeah, that's a good question. And I think the obvious one perhaps is EBITDA margin. I think what we really want to do as we continue to scale the assets under management is to really focus on the efficiency that the increasing scale will bring us, and therefore we hope to see, and we intend to drive growth in our EBITDA margin over time as well.
Thank you, Martin. Another question talks to it is a substantial year for us in terms of the organic fund inflows from institutional funds, from the BBB funds, and from our retail. So across all the 3 pools of capital that we manage has been a substantial year for us. It's not a one-off, but it will be not replicated next year. So that's why the 10% and not a more aggressive burden on that. And what drives the 10% is retail activity and institutional activity in the early days. Now, as we move into real assets and as we build an internal institutional distribution team, we would expect that, of course, to greatly scale. But in this year, as we're going through the building process of that, it's a 10% target inflows, and that's really what's driving that.
And there's a question just come in, Mark, actually on that, and why are you targeting 10%? And although one can never be certain when it comes to fundraising, we do have a pipeline of organic fundraising activities for the current financial year.
I think just finally closing out, and this is a kindly framed question, so thank you. How do you plan to sustain and build upon the record growth in the coming years? And that's through specialism. So really what we're saying there is we've grown now to a capability where we are looking at specialized units. So we almost have a mechanism, a machine. So deal origination is working extremely well. We're seeing great investment prospects coming through to the group. Retail distribution is working really, really well. We've had record EIS and VCT fundraisers for the year. Institutional distribution is new to us. It's something that a number of people have done almost as a second job. We're looking at that being a centralized function to do that and go forwards. We have inbound interest for capital, which is frankly the first time I've ever had that. So we have been chasing money rather than money chasing us. And we feel we're very, very well placed with things like the Mansion House Compact, which is really helping, and for us, this is predominantly local government pension schemes, but really helping capital think about how do you deploy regionally and domestically capital through the regions, through houses such as MERCIA. And that is an exciting time that we find ourselves in. So that is the sustainable element here, as we've built the infrastructure, we've built the track record of delivery, we're building the distribution teams, and we expect that to generate a sustainable high growth business going forwards.
Mark, Martin, thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to yourself and the company, Mark, could I please just ask you for a few closing comments?
Thank you. And to that point, we do welcome feedback. We are trying to grow a valuable business with impactful meaning across the UK and the regions, and listening to all our shareholders. Their comments, concerns, etc., are very important to us. I hope you agree with both Martin and I that what we have is the start of something that is building momentum at the moment. There are now tailwinds behind us. We have a very strong financial position, strong unrestricted cash as well, and actually a compelling balance sheet that will help us fund our next growth and generation. So thank you very much for your support and for your time today.
Mark, Martin, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and I'm sure will be greatly valued by the company. On behalf of the management team of MERCIA Asset Management PLC, we'd like to thank you for attending today's presentation and good afternoon to you all.